Hey, good morning, everybody. Welcome to the live morning meeting. Thanks for spending your time with me, getting started for the trading session this morning. So we're going to just go over how we're going to attack the day and some big picture thoughts, keep our head straight. I like to do this in the morning with all of you, with myself, because sometimes you forget from one day to the next, where you were in the market, and you start to get pulled astray, particularly after the weekend. You've been reading a whole bunch of stuff. You get a whole bunch of noise drilled into your head from all different financial sources. And so what I like to do is try to laser focus myself. Where are we from a risk monitor point of view? What would have to change to get the risk monitor to go green? That's what drives our risk decisions. And then where will we go with capital? Because that's all that matters. Everything else is just noise. All right. So don't forget, what are we doing here? We're investing together the Armor Investing Way. It's a virtual hedge fund trading desk. Okay. You guys, whoops, there's nothing there to show you. Let's see if I can do this. Nope, it's not there. All right. You guys are on a desk with me. Okay. So think of this as a hedge fund. You're the portfolio manager of your own assets. We're having a morning meeting like hedge funds do. I used to run a couple hedge funds. This is what we did. And we would set up the day. Here's what we're trying to do. And then all of the portfolio managers, boom, go out there and make your own decisions following your own risk tolerance, your own goals, the type of capital you're running, conservative, balanced, or aggressive, or somewhere in between there. That's your decision to make. What I'm going to do is share with you the top 3 stages, the essential stages of how to run money successfully. Working on our whiteboard, doing fundamental research, getting ourselves ready for the next wave, using algorithms to execute, starting with the big picture risk monitor all the way down to day trading algorithms, and then following strict risk management rules. And we're all each other's risk managers. So call me out during the day if you think I'm doing something outside of the structure of what the Armor Report's all about. And the structure comes down to this. Let's get on the right side of probabilities when reward is worth the risk. Every decision comes down to that. Cut through the noise that's going on in your head with that one question. You're about to make an investment. Are you on the right side of probabilities? Is the reward worth the risk? It's not a question of, do I love this idea? Is it finally cheap enough? Who knows? Maybe. Let's roll the dice. That's not how you invest. How do we get on the right side of probabilities? Algorithms. Let's go look first at the risk monitor and figure out, and we're going to use just the S&P as the guide here. So what's our stance this morning? All right. So I do this every morning to help myself. So massive uptrend. Not because of some great fundamental piece of information, but one simple reason. The Fed decided to add massive amounts of liquidity. Bull market. Be as aggressive as you want. Okay. Then the market tops as the Fed starts to discuss the fact that maybe they've put too much liquidity into the system. All right. So we're still out there putting money to work. We're still dancing through raindrops, and we're seeing our net worth go up while the market starts to head south, and while parts of the market are absolutely plummeting. Okay, then the market starts to break down when the Fed actually begins reducing liquidity. I'm putting these yellow lines in here so you can see each Fed meeting. The low of that day becomes resistance. When it starts to become support, we know maybe we're getting towards the end of the selling. Okay, but it's resistance right now because the head and shoulders top that formed is now in a downtrend. And so what I've got for you is the red dash line, which is the 200-day moving average downtrend. It's a channel. I've done this before. I've been in bear markets before. Trading the channel is really a great way to run money at this time, a great way to trade. So what we look to do is short the top of the channel, buy the bottom of the channel. Okay. So I don't just buy a falling knife. So I'm not long right now. And the market's gapping up a little bit this morning, but I'm looking long because just look at the chart. Okay. We're at the bottom of each channel. So the solid red line is the 50-day moving average downward trending channel, and the dashed line is the 200-day. And during this decline, which my guess is it's going to last for months, excuse me, or until such time as the Fed says we're done raising rates and we're going to start adding liquidity, and we're not going to reduce our bond purchases anymore. You know, they're reducing the balance sheet right now. So the market, the only direction for the market's lower with short-term violent rallies along the way. Don't forget, this is a fact, okay? Going back, I don't know, to the buttonwood tree, okay? The strongest 2 to 3 day rallies happen in bear markets. The strongest face melting 2 to 3 day rallies happen in bear markets. They happen because, for whatever reason, shorts decide to book profits and there's a vacuum. They happen because shorts are notoriously fickle is not the right word, but scared, right? Because shorting is a dangerous thing. You're short and it starts to go against you, and it's like a mind-altering experience, okay? So they're quick to cover. There's massive amounts of puts out there. Puts finally get dumped. We had OpX, June OpX last week that took a bunch of these puts off the board, which makes for some room, okay? So there's unwinds that happen, and then there's vacuums that get filled. And so you could get these rips higher. And interestingly enough, when we use SpotGamma and look at the put activity, these puts got rolled lower. So the put wall just dropped. So we're in a very strange market right now. There's a lot of option reasons after the OpX for the market to rally, just to blow off some steam after unbelievable compression, okay? But at the same time, the put wall dropped. So when the put wall drops, it means there's no real support. So how do we trade this market? Well, because we're down here, okay, at the very bottom of both of these channels, it doesn't mean we can't drop out of it. But what I'm looking for is a reversal and to get on a trade that lasts for a couple days. Maybe it lasts for a week or two. That trade will not change the risk monitor to green. That does not mean it'll be time to start putting a bunch of money to work. All I'm doing right now is focusing on capturing alpha. Look, the ARMOR report, whether you're aggressive, balanced, or conservative, has protected capital in a horrific bear market. We're somewhere around break even. If you take an average of all the portfolio approaches, maybe you're plus or minus 5%, okay? Market's down, what, 40% for the IBD 50, which are innovative stocks. Down, what, 75% for the ARK fund. Forget about that, right? The NASDAQ, what did we just say this morning? I took a look and posted it for you. Put it in perspective. The NASDAQ's down 31% from the start of the year. 31% from the start of the year. So if you're plus or minus 5% on the year, you're crushing it. All you have to do is protect capital during a collapse like this. But the next step, the two things have to go together. You got to capture the alpha you've created. It's a moral imperative. It would be, and this is a fear of mine, and I'm going to share it with you. This keeps me up. I wake up in the middle of the night, right? If I create this kind of alpha and I don't capture it, what's the point? What am I doing here? It's great to miss the collapse, but if I don't capture the upside, then I'm just, I mean, what am I doing? I'm just sitting in cash, right? So a certain amount of alpha I'm willing to spend looking to capture that upside. That's really what I'm doing. So when you see me day trading, and it's been brutal for the last 2 weeks, okay? Nothing's working on the day trading desk. I mean, it's just crazy. There's a couple of reasons for that. But the reason I keep looking for it is that is the ultimate goal. Hey, we're investing here. The ultimate goal is not to become overly bearish. This is my message to you today, because I read a lot over the weekend, as I'm sure you do. And more and more and more people are becoming like Armageddon people. World's coming to an end people. Okay. And the more I hear that drumbeat, world coming to an end, the more I know I need to stay focused and look for a long opportunity in the S&P because it's coming. You know why? Because we get on the right side of probability and statistics here when reward's worth the risk. And the statistical probability that the world's coming to an end is small. If it ever does come to an end, investing is the least of our worries. Okay. So we can't run money listening to these Armageddon people. Now, I love Hugh Hendry, but God knows I listen to him every Friday just because it's fun. I think he's interesting. I look for some interesting investing ideas that he might reveal. But his take on the world is like world-ending stuff. I mean, Hugh, if you end up being right, what's the point? You know, what's the point of what we're doing here? I mean, you can't live life worrying about the end of times. And he's just one example. I mean, I stopped reading Zero Hedge years ago. They're just stuffing into your head constant misery. And they're wrong 99% of the time. Then the market crashes and they crow about how right they are. But they've been wrong for the whole bull market. Don't start listening to these people who are fear-mongering, pretending that they're right. They've been wrong throughout the whole bull market. We can't get caught up in that. And the louder the drumbeat gets of the end of the world and all these problems, I know all the problems. Inflation through the roof, food processing plants in the US are burning, there's war in the Ukraine. All I can tell you is I've been through this, okay, multiple times. And there's always a litany of end of days type of scenarios that comes out of the woodwork from every quack that you can imagine. Now, it doesn't mean the market's not going lower for the next, who knows, 3, 4, 5 weeks, 3, 4, 5 months. It may. But betting that it's the end of the world is a low percentage bet. And it does nothing for us thinking about that, right? So just put that over here. Turn that noise off. Just execute. So that's why I keep searching for this S&P trade. There's going to be a face-melting rally. I'm going to try to get on it. I can't guarantee I will. Sometimes they get away from me. This morning's gap up. I never buy gap ups to start the week. Those of you who've been with me for a long time know that. So my money trade today, what I really am looking for today, what I'm going to hit hard if I see it. Gap up, sell off to test the lows of last week. That holds. And we get one of the 5 armor day trading buy signals on the S&P. I'm going to hit that hard. And at the same time, I'm going to put out the flip trade. That's the bread and butter of what we do. All the other stuff has been brutal, okay? This is what works for us. The first trade I look for, S&P long. The second trade, I don't look for it. When I get long the S&P, I immediately go out there. I identify the prices where I would be short the Qs and the small cap. And I put the shorts into the market on a sell stop basis. You know why? I don't like to use sell stops, but I do it in this case. Number one, to protect my long position, just in case something happens, the market plummets. While I'm getting out of my S&P, I'm getting short automatically. But the other reason is I hate getting short. I mean, so when it's hitting the prices, I stare at it and go, no way, the market can't go lower again, right? And so the sell stop forces me to get short. I can't tell you how many times that makes me money. And I make money on the trade, and I'm like, I can't believe I'm making money on this trade. I don't want to be short. I can't believe it. So that is the trade I'm looking for. I want to trade less today. This market's been very difficult to trade because it's been gapping. Gap ups, gap downs, and then just trade near the opening range. So there's no extension in either real direction. Then this is a perfect example. Gap up 1.5%. And what's it going to trade during the day? It might trade in a 0.5% range. And it'll just chew you up, chew you up, chew you up because it looks like a long trade. It doesn't go anywhere. Then it reverses, not a short trade. Doesn't go anywhere. Then it pops back up. So we got to avoid that. So I'm identifying one trade I'm looking for. If I see it, I trade it. If I don't, I'm not trading today. When I say test the low of Friday, it doesn't have to go below the low of Friday. It doesn't have to touch the low of Friday. It's a test. It can look all different ways. Gap up, sell off in some way. Can make a higher low, can make a lower low, can be a double bottom that's perfect. Who knows? I look for the move down, and then I look for one of the 5 armor buy signals using the day trading algorithm, put the trade on, put the flip trade out, either make money on the S&P, lose money on the S&P, get short, and make back whatever money I've lost. When I get short, I'm not looking for huge gains. The reason why I think that flip trade works is because I'm not looking for something huge there. It just makes back whatever money I lost, and maybe I make a little more. So when it goes down, I book profits quickly so now I'm break even on the day, and then whatever's left, if it keeps plummeting, I make some money. That's kind of how I flip trade. All right. Those are my thoughts this morning. But when I look here, I do think that a rally in here is more likely than total and utter annihilation from here. It's just due. It's just due. And it's either going to be a 50-day moving average rally back up towards this yellow dashed line that it can't get above, or the rally will last a couple weeks, bringing the 200-day line down, and it'll touch that line. Okay, when it gets there, I'm going to put on some investing shorts. So I'm doing research now, and I'm filling up the whiteboard now with stocks that I want to be short after the rally. Okay, so go look at the whiteboard. You can see what I've put up there so far, and I'm going to be looking for other names I have an interest in shorting. I do have an interest in being long treasuries. Now, treasuries are down 1.75% at the open. Is that true? I don't know if that's statistic. I don't know if the data I'm looking at is right. Let me take a look at TLT. Is that bid and offer right? Yeah, it is right. All right. So I'm definitely looking to trade treasuries, and I could see myself having an allocation to treasuries as an investment before I get long the S&P for a risk monitor green trade. In other words, bonds lead stocks, and we were all over that at the Armor Report. I was sharing this with you up here, right? I said to you guys, I'm sure you guys remember this, but for those of you who are new, we've been watching bonds for a while, okay? We talked about the breakdown right here that was starting to decline, but really we went over corporate bonds, remember? So back here, this was all the way back in March of last year, at February, March, right? That breakdown, we said, okay, that's what killed ARK. All right. And then right in here, and this was, what was this? January of this year, I shared this chart with you guys, and I said the breakdown in LQD, which is corporate investment grade bonds, is about to crush the Qs. Okay. And we were already risk monitor red in here, and this was the lead indicator that it was over. And, you know, just to ring the bell for a second, the NASDAQ's down over 30% since that conversation with you based on bonds. Okay. So it's incredibly important. I share that not to say, hey, I was right, although I was, and it's kind of fun, but I really share it with you because I want you to see how important the bond market is when it leads equities. When LQD broke down, that was it. Equities were done. Now Qs are down over 30%. So bonds will lead stocks out of this bear market. And so for us to have an allocation, not to LQD, although I don't know, maybe that would be a good idea at some point. I got to think about that one. It just hit me. But my first goal is to own treasuries, long treasuries. Okay. There's no reason to own them right now. As you can see, they're in a complete free fall with, lower lows and lower highs. But I'm watching this. And truth be told, I'm working on the algorithm. I don't have a specific algo for TLT, but I'm working on it already. I'm going to continue to work on optimizing what I do have to see if I can and I'm pretty sure I can because it's not that hard to trade this, tweak it so I can optimize it for treasuries so we can get a risk monitor green on bonds. And that will lead us into our treasury trade. So I'm looking to get long TLT. Just trying to wrap up, make sure I've got everything clear here for you. I want you to remember that just because we get long the S&P in here and maybe we hold it for a couple of weeks as it bounces does not mean it's going to change the risk monitor green. There's been such devastation across the board to the indexes that the first move off the bottom, that first 3-bar reversal, which you might think will turn the risk monitor green, is not going to turn it green. There's fail safes written in for bear markets, and it's going to require double bottoms. It's going to require tests. It's going to require a bigger bottoming structure. So the first time we get this 3-bar reversal, okay, right in here, and it got us risk monitor green, and we just got thumped on it, right? It didn't go anywhere, and it went red right there and created losses, okay? So now we're going to get another 3-bar reversal like this, and we're not going to get risk monitor green. I might, change it yellow just so you understand what's happening. But yellow, risk monitor yellow, to me would mean all I'll do at this stage is own probably the top 4 indexes, the S&P, the NASDAQ, the Dow, and the small caps. So I would only trade those 4. Maximum liquidity, easiest to trade, capture some of the alpha, but recognize that we're not even close because of the destruction that's going on for a real investable market to begin. So I'll trade those 4 indexes for a quick swing trade, and I'll change the risk monitor to yellow to let you know what I'm doing. But there's no way it's getting green in here. It's going to take weeks. It's going to take weeks of a bottoming structure. And what's happened before coming out of bear markets like this, there were 4 risk monitor green signals in 2008. They all lost money, okay? So in bear markets, you can get some risk monitors that just lose money, risk monitor greens that lose money, one after another. There's no secret sauce to a risk monitor green. It's a probability algorithm. So it's going to be wrong part of the time. And in bear markets, it's going to be wrong more than it's right. I mean, that's just a bear market. Okay. So we have to recognize that. And after 2008, I went in there and I said, okay, once we enter a bear market, once we've had a risk monitor green fail miserably like that, then what we want to do is look for structure to create a bottom and then get a risk monitor green. So we can trade the volatility in between, call it risk monitor yellow, stick to indexes, but we don't really start filling out a portfolio until we've got a bottoming structure. So nothing's going to change right now. Just wanted to let you guys know that. And it probably won't for weeks. Okay. And particularly not if the market skyrockets higher for 4, 5, 6 days. That'll be a classic short covering rally that we will not want to put any money to work in except for indexes. And then when it comes back down to test, if we then get structure, then we start putting money to work. Okay. So that's where my head is to this morning. Is there anything else I wanted to share with you? No. Oh, you know what? Just the only thing I want to share with you is the research that we're doing right now is looking for relative strength lines that are breaking out versus the S&P. So we use the Investors Business Daily and MarketSmith for this type of analysis. Okay. I'm going to go like this. I don't know why it's not giving you a number, but it's like 86, 87 relative strength right now. So we look for a price high corresponding relative strength. We look for the price low, but the relative strength blows out to a new high. So what that's telling you is the relative strength of gold versus the market is getting stronger and stronger. And what William O'Neill teaches us is that you can get that for a period of time where the relative strength blows out, even though the price is going down or consolidating, but it leads to a price blowout. Price follows relative strength. Now, here's the tricky thing. As you all are helping me build the whiteboard, in a bear market, you can fill up your whiteboard with relative strength leaders of low beta boring stocks, which is not happening right now, but I'm just saying you can, low beta boring stocks that will, when the market starts to go up, be the source of capital for growth stocks. Okay. So if your whiteboard's full of, this is a bad example because Kellogg's is up 8% today because they're breaking the company up. But if the portfolio is full of Kellogg's and Procter and Gamble, which are the type of names that people hide in a bear market, those stocks go down when the market starts going up. So we don't want a portfolio full of that. We want a portfolio, we want to find relative strength leaders that are growth stocks that are going down less than the market, that are consolidating while the market plummets, because those growth stocks will skyrocket when growth comes back into the market. So you follow me? Don't build a portfolio full or a whiteboard full of defensive, defensive names, because that'll just be a massive disappointment. So we have to nuance it here. So gold is really interesting to me, although gold stocks don't look that good. So I'm not buying GDX yet, but I am looking at Sprott physical gold. And then here's a couple of examples, like Eli Lilly. Here's a growth stock, relative strength blowing out as the market goes down. There's an example of a great relative strength. Or how about VRTX? This is fascinating to me. The biotech space is getting crushed. And VRTX has a 96 relative strength that's blowing out on Friday. Make it a huge cup and handle. You see, that's what I'm talking about. That's a growth stock. That's a biotech stock. Biotechs are getting destroyed. And somehow VRTX is going to 96 relative strength. That'll be one of the first stocks to blow out to new highs when this bear market's over. So I want a list of names like that. Then we do research. We go listen to conference calls. We try to figure out, why does Veritex look that good? And if all of the bases are covered and the stock continues to hold up and we get a risk monitor green, bang, we're putting that stock in the portfolio. So that's what I'm trying to find a list of. That's the list I'm trying to build. And I welcome any of you to add your thoughts to the list in the Slack room. We'll do research on it together. So those are my thoughts for the day. Any quick questions? If not, I'll see you on the live trading desk. For those of you joining me on the live desk, that'll be over under in the Channel Armor Pro live desk. So I'll see you over there in a few minutes. Thanks for starting your morning, and I wish you all a great day of trading. Take care, everybody.